Imagine you're walking into a brightly lit office to buy your very first car insurance policy. There is a friendly person sitting across the desk offering you a cup of coffee, asking all about your new car, and navigating through a bunch of screens to help you find the right coverage.
Yeah, it feels incredibly personal, like they're your advocate, your personal shopper in this really complex world of risk.
Exactly. But if you pull back the legal curtain on that transaction, that invisible line across the desk becomes a massive, rigid boundary.
Oh, for sure.
That friendly person handing you the coffee. Legally speaking, they aren't working for you at all. Today, we're opening up a fascinating stack of notes from the Insurance Study Companion to unpack this dynamic.
And until you understand the underlying legal architecture of that desk transaction, the rest of the entire insurance ecosystem is going to look completely backwards.
Okay, let's unpack this. Whether you're a CPCU student grinding your way through those heavy textbooks, an insurance professional brushing up on fundamentals, or just a beginner who wants to understand how buying a policy actually works in the real world, well, this deep dive is designed for you.
It really is foundational stuff.
We are tackling a seemingly simple question that hides a massive legal distinction. What exactly is an insurance agent? Because before we can look at what an agent does on a daily basis, we have to establish who they are.
Right, and that brings us right to that massive misconception we just opened with. To set the baseline, we really need to look at the formal definition.
Which is what exactly?
Under the law, an insurance agent is a licensed individual or a business entity authorized by an insurer to sell products and perform functions on the insurer's behalf. They solicit, they negotiate, and they sell policies.
But those last few words dictate everything, don't they? On the insurer's behalf.
What's fascinating here is the critical legal reality stemming from that specific phrasing.
Right.
An agent is a representative of the insurance company. Even though they're analyzing your personal needs and helping you fill out the application, their primary legal duty, their fiduciary responsibility, is owed to the massive corporation they represent.
So you're the customer, but you are absolutely not their principal.
Exactly. You are not the principal.
The notes have a memory trick for this, but to make it really stick, think about a massive professional sports franchise. The insurance company is the team.
Okay, yeah.
The agent is the team's designated salesperson. They wear the team's jersey. They are working for the franchise to sell tickets and merchandise.
You're definitely not working for the fan who walks up to the box office.
Right. Their job is to protect the team's interests and generate revenue for the team.
And that structural reality is exactly where the Insurance Study Companion flags a major trap, specifically for students taking CPCU courses, like 520 on operations, 530 on law, and 540 on finance.
Oh, the agent versus broker distinction?
Yes. The materials lean heavily on this. A is for agent, and the agent acts for the insurer. B is for broker, and the broker buys for the customer.
So a broker is essentially a freelancer hired directly by you, the insured.
Exactly. You mandate them to go out into the broader marketplace, analyze various options, and procure a policy on your behalf.
And if a broker makes a catastrophic mistake in securing your coverage, the legal liability generally falls on them, right? Through their own errors and omissions insurance.
That's right. But if an agent makes a mistake while acting within their scope, well, the insurance company itself is often on the hook because the agent is the company in the eyes of the law.
So the exam questions and, honestly, real-world lawsuits, they love to twist this.
Oh, but
They present a scenario where a local agent is super helpful, acts like your best friend, and promises to find you the best deal. The question then asks if they legally represent you.
And if you don't have that AX for the insurer rule locked in, it's incredibly easy to get fooled by the friendly customer service aspect.
Yeah, I mean, it feels like they work for you.
But the law doesn't care how friendly they are. The law looks at the formal appointment contract.
Well, if the agent is legally handcuffed to the insurer, if they only work for the team, the natural next question is about the business model itself. Are they married to just one insurance company? Or, can they play the field?
The industry actually splits this into two distinct distribution channels. You have captive agents and independent agents.
I mean, the name captive paints a pretty vivid picture.
It really does. A captive agent, which the industry sometimes calls an exclusive agent, signs a contract to represent only one insurance company. These are the household names dominating television commercials.
So when you walk into one of those branded storefronts, that agent can only sell you a policy from that specific parent company.
Right. And from a business perspective, the trade-off is clear. The advantage for the captive agent is deep, specialized knowledge and immense corporate backing.
Because they only sell one company's suite of products, they know the underwriting guidelines inside and out.
Exactly. They usually receive heavy subsidies for their office space, national marketing campaigns driving foot traffic to their door, and robust administrative support.
But the disadvantage is a severely restricted product shelf.
Yes, very restricted.
If a customer walks into a captive agency with a complicated risk, say they have a terrible driving record or they own a highly specific type of manufacturing business, and the captive's parent company doesn't have an appetite for that risk, the transaction is just over.
Yeah, the agent can't just pull a competitor's application out of their drawer. They have to turn the business away entirely.
Which opens the door for the independent agent model. Independent agents run their own standalone businesses and sign contracts with multiple different insurance carriers.
Right. The notes-less carriers like Travelers, Liberty Mutual, The Hartford, and Progressive as companies heavily utilizing this channel.
And for the consumer, the advantage is obvious. You go to one office, and the agent runs your risk profile through 5 different carriers to find the most competitive rate.
Insurers love the independent model, too, because it allows them to penetrate local markets without paying the massive overhead of setting up branded storefronts. They just pay the independent agent a straight commission on what they sell.
Okay, wait a second. I need to push back on this.
Sure.
If an independent agent takes my information, runs it through their software, shops it around to Travelers and Progressive, and comes back to me with the lowest price, aren't they basically acting exactly like a broker?
I mean, functionally, from my side of the desk, there is zero difference. It feels identical.
Right. So how is that legally different?
Legally, the distinction comes down to those appointment contracts again. An independent agent is not hired by you to search the entire open market. They are authorized representatives for a specific, pre-contracted stable of carriers.
Oh, I see.
When they quote your auto policy with Progressive, they are acting as Progressive's authorized agent in that specific moment. They sell the insurer's products. You did not hire them as your legal representative.
So A still acts for the insurer, even if the agent holds 5 different insurer contracts in their filing cabinet.
Exactly. The legal tether is still tied to the insurance company's desk, just multiple desks at once, if that makes sense. You aren't paying them a fee to shop for you. The insurer is paying them a commission to distribute their specific product.
It's a subtle operational difference, but a massive one in terms of liability and regulatory compliance.
Oh, absolutely massive.
Now that the legal boundaries are established, we need to look at how this invisible line actually impacts the everyday process of getting covered. Let's run through the real-world example from the study companion.
The Sarah example.
Right. Sarah wants personal auto insurance, so she contacts an independent agent. The agent collects her car's make and model, her driving history, and her address. They pull quotes from 3 different insurers, recommend the best fit, and submit Sarah's application.
It sounds incredibly mundane when you lay it out like that.
But here's where it gets really interesting.
Yeah.
Every single step that agent just took with Sarah has a direct, profound impact on the insurance company's balance sheet.
Because the agent isn't just processing paperwork. They are the gatekeeper to the insurer's financial survival.
How so?
Well, the entire system rests on the agent's initial interactions, primarily through underwriting. Underwriting is the mathematical evaluation of risk.
Right. The actuaries at the home office build the pricing models, but they rely entirely on the agent being their eyes and ears on the ground.
The notes emphasize that agents gather property characteristics, driving histories, and details about business operations. Let's look at the butterfly effect of getting this wrong.
Okay.
If an agent is inspecting a commercial building for a new policy, and they fail to note that the building has an outdated, highly flammable roof, the underwriter back at corporate is going to price that policy based on a standard safe roof.
And when that building inevitably catches fire, the insurance company takes a massive actuarial loss. They're paying out hundreds of thousands of dollars, all because the agent missed one crucial detail on the intake form.
Exactly. Poor information at the point of sale destroys the mathematical models insurers use to stay solvent, and this flows directly into pricing.
Right. By gathering all that raw data, the agent effectively places applicants into their risk classifications. They dictate the coverage limits and the deductibles.
And if the agent misclassifies a risk, say, to do a favor for a client and get them a cheaper rate,
then the insurer isn't collecting enough premium to cover the statistical likelihood of a claim.
Yep. The agent's role also extends significantly into claims and risk management. While independent adjusters generally handle the actual financial settlement of a claim, the agent is almost always the point of first contact.
That's true. When you get into a car crash, you don't look up the corporate 1-800 number for the claims department. You call your local agent because you know them.
Right. The agent initiates the claims report, they triage the situation, calm the customer down, and explain how the process is going to work.
And beyond that reactive role, they have a proactive risk management duty too, right?
They do. A competent agent reviews their client's coverage periodically. If Sarah just bought a new house, or a commercial client just expanded their warehouse, the agent needs to identify those new exposures and plug the coverage gaps before a disaster hits.
Because agents hold the keys to the insurer's underwriting vault, and because a single missed checkbox can cost an insurer $1 million, there has to be a rigid framework to control that power.
Yeah, you can't have thousands of commissioned salespeople legally binding a massive corporation to unpredictable risks without a heavy regulatory leash.
The study companion stresses this heavily. Agents must hold a valid state license. Insurance is regulated state by state, not at the federal level.
That's a huge point for exams.
Agents have to complete ongoing continuing education, pass background checks, and comply with strict, unfair trade practices laws to ensure they aren't engaging in deceptive marketing.
And while the licenses are issued by individual state departments of insurance, the baseline standards are actually coordinated nationally by the NAIC.
The National Association of Insurance Commissioners.
Right. This prevents the industry from fracturing into 50 completely different regulatory environments.
If we connect this to the bigger picture, all this regulation really points toward a core concept that insurers obsess over: fiduciary responsibility.
Fiduciary duty is the highest standard of care in law. When Sarah hands her premium check to the agent is holding the insurance company's money.
And they are required to keep those premium funds in heavily regulated trust accounts.
Yes, if an agent commingles that premium money with their personal operating account to pay their agency's rent, they aren't just breaking a rule, they are committing a crime. They hold those funds in a strict fiduciary capacity for the principal.
That structural trust leads to a highly practical question.
Yeah.
If I'm sitting in that brightly lit office and I've signed the auto application and the agent looks at me and says, "You are covered as of right now, you can drive off the lot," am I actually covered?
Can they just decide that on the spot?
Yeah, before the home office underwriters have even seen my file.
This is the final and perhaps most heavily tested trap on the CPCU exams. Authority. Specifically, binding authority.
Binding authority is the legal power to make an insurance policy effective immediately, right?
Yes. I think the common misconception is that if someone has an insurance license, they have a magic wand to grant coverage.
I definitely used to think that.
It is absolutely false. Let's upgrade that metaphor, actually. Don't think of it as a magic wand. Think of it as a corporate credit card.
Oh, I like that.
When an agent binds a policy, they are swiping a card that draws directly from the insurance company's multi-billion-dollar bank account. Insurers place incredibly strict spending limits on those cards.
So binding authority depends entirely on the specific contract between the insurer and that specific agent.
Exactly. One agent might have the authority to instantly bind a standard personal auto policy up to $1 million. Another agent, dealing with complex commercial liability, might have zero binding authority.
They just have to submit the application and wait for the corporate underwriter to approve it.
Right. And this creates a critical legal division that students must master: actual authority versus apparent authority.
Actual authority is the written rule book. It's the agency contract explicitly stating, you may bind standard auto policies, but you may not bind commercial trucking risks.
Yes, actual authority is the express power granted. But apparent authority is where the massive multi-million-dollar lawsuits happen.
Because apparent authority is entirely based on what the customer reasonably perceives based on the insurance company's own actions.
Precisely. Imagine a scenario where a business owner walks into an agency to buy coverage for a new restaurant. The agency has a giant illuminated logo of a major insurer on the building.
The agent hands the customer a business card with that same logo. The application is on official corporate letterhead.
Right. And the agent takes the premium check and hands over a branded binder saying, "Your restaurant is covered starting today." To the customer, it appears undeniably clear that this agent speaks for the insurance company.
But let's say the agent had a terrible track record with restaurant risks, and the insurer had secretly amended their contract 2 weeks ago, completely revoking their actual authority to bind restaurant policies.
The agent wasn't supposed to swipe the corporate credit card, but they did it anyway. And that night, the restaurant burns to the ground.
Who pays for the fire?
The insurance company pays.
Because the insurance company gave the agent the illuminated sign. They gave them the branded binders and the letterhead. The insurer created the environment, the appearance, that the agent had the authority to act.
And the law protects the consumer here. You, as the business owner, had no possible way of knowing the secret internal contract details between the agent and the home office.
You relied on the apparent authority that the insurer themselves deliberately set up.
Exactly. The insurer is legally bound by the agent's actions in that context, and they have to pay the claim. They will subsequently sue their own agent for breaching the actual authority contract, but the consumer is protected.
It fundamentally explains why insurance companies are so intensely paranoid about who they appoint. They are handing out corporate credit cards and branded letterhead that can legally lock them into devastating financial losses.
They are delegating the financial security of their entire institution to thousands of independent actors across the country. It's a huge risk.
So, what does this all mean? Let's bring all these mechanical pieces together for you. We've pulled back the curtain on a role we all interact with, but rarely fully understand.
The Insurance Study Companion does an excellent job of breaking down a complex legal relationship into digestible, testable parts.
Here is the concise summary, the ultimate takeaways to lock in. First, an insurance agent legally represents the insurer, not the customer. Remember, the fundamental rule A is for agent, and the agent acts for the insurer. B is for broker, and the broker buys for the customer.
Second, agents operate in two main distribution channels. Captive agents represent one single company, trading product variety for deep expertise and corporate support.
And independent agents run their own businesses and represent multiple companies to offer price comparisons, though they still legally act as the authorized representative for whichever carrier they place the policy with.
Third, agents are the financial gatekeepers for the industry. They control the flow of underwriting data, dictate pricing classifications, and act as the frontline triage for claims.
Because a single missed detail can cause catastrophic losses, they are heavily regulated by the states and bound by strict fiduciary duties to handle premium funds ethically.
Finally, their power to instantly grant coverage, their binding authority, is dictated entirely by the strict limits of the corporate credit card they've been issued by the insurer, not by the assumptions of the customer.
This raises an important question.
Yeah, I want to leave you with a final thought to ponder, building directly on that dangerous concept of apparent authority. The next time you walk into a local agency, or even when you just visit an insurance quoting website, take a very close look at the logos, the branding, and the official-looking letterheads surrounding the transaction.
I love this point.
Ask yourself, in this moment, are you relying on the actual authority that person possesses, hidden away in a secret contract? Or are you just trusting the apparent authority that a massive financial institution has deliberately manufactured to make you feel secure?
It really makes you look at that invisible line across the desk in a whole new light. The friendly face is real, the help is real, but the heavy legal machinery is always operating quietly in the background.
It's a completely different perspective.
Thank you so much for joining us for this deep dive into the Insurance Study Companion. Keep studying, keep asking the hard questions, and keep learning. We'll catch you on the next deep dive.